Hi, welcome back to the series of videos on Ind AS, that is Ind AS with Accountsman. In the previous lecture, we had started with Ind AS 23 borrowing cost, and we had also discussed what exactly do we mean by borrowing cost, what are the exclusions from the borrowing cost, and why exactly do we have a standard on borrowing cost. So in the present discussion, we will be discussing how exactly do we compute the amount which is to be considered as a part of our borrowing cost. Meaning, in the previous lecture I told you the standard covers about these three things, 1, 2, 3. So we're going to discuss each of them in details now. Yeah, we'll get started. So firstly, we'll start with interest at effective rate. So I'll rewrite it at a later stage. So the entire discussion is about how do we treat or how do we compute these three items. Number 1, interest at effective rate. So this is the first point of discussion. Come on, let us start discussing with regard to interest at effective rate. Yep. Whenever I tell interest at effective rate, this will always include number 1, interest and commitment charges. Now, what exactly do we mean by commitment charges here? That's interesting discussion. Now, whenever we take borrowing, we need to pay interest. So, in order to take that borrowing, there are certain procedures that we need to go through. Example, if I want loan from a specific bank, I would have to go through my credit rating to be proved to them. My income statement need to be proved to them. I need to apply, and the entire thing has to be processed by them. They need to check the background verification. They need to get some guarantees done. After everything, we need to whatever I pledge as an guarantee, that has to be, the document has to be drafted, everything needs to be signed, everything has to be, the stamp duty has to be paid. Only then the loan will be granted. So this entire process might take some time as well as it might cost some money, and that has to be borne by me because I am the person who's interested in this entire thing. So if there is a concept of processing fees, firstly interest is always covered. Next question is processing fees. If there is any of this cost called as processing fees which is charged by the lender to the borrower like me, is it part of borrowing cost is the question. The answer is pretty simple. It is part of borrowing cost. Now the question is why? Because it is committed. I have committed to take the loan, so I would have to pay this money. So as it is part and parcel of me borrowing the money, it is part of my borrowing cost. Without doing this entire processing, I will not be able to borrow the money at all. Done. So the next thing that I am going to discuss here is prepayment charges. Now I have borrowed the money for 10 years, meaning I would have to repay the money over the period of 10 years. Not necessarily at the end of 10 years, but over the period of 10 years. But assume that all of a sudden I've got a lot of money after some year 3 and I want to repay the entire money after 3 years. But I still have 7 years time, but I don't want to wait for 7 more years. Now you might ask, why is it that I want to pay 7 years in prior? If I pay 7 years in prior, I might save some interest of that 7 years. You get that? Now, why is it that I'm paying 7 years in prior? Maybe there is some amount of cash flow that is coming in, or I'm winding up my business, or some such arrangement wherein, or I'm finding a cheaper loan from a different bank. So that is the reason I'm taking loan from that bank to repay the loan from this bank, which is at higher rate. So if I'm doing such kind of cases, I'm repaying the loan earlier than the date which was previously promised. Now you might assume that the banker will be very happy that he's getting the money back in time, but that's not the usual case, because now we need to find another person who will take this money from him at such interest rate, because the loan that we take from the bank is a contribution made by from some person as savings. The bank has to pay him interest. In order to pay him interest, bank has to lend this money. Bank was happy that I had borrowed the money. Now all of a sudden, if I repay the money, the bank has to immediately find another lender, so other borrower, which is actually of very great difficulty. Now, in order to make you understand, assume that I am a hotel person and you are my customer, and I have been obliged to basically deliver you one plate of idli every day for the next 30 days. So I am very lazy, and day 2 I deliver you all the 30 plates of idli, and then says you keep it and then you eat it. So now what will you do with that? You can't eat it all, so you need to sell it. So basically you are under loss here. You get that? So you might not be very happy with it if I basically repay it in early. And prepayment charges are charges that are levied by the lender in order to charge for the borrower for him paying the money well before the agreed date. So this is penal in nature and this is not part of our borrowing cost. You get that? Whereas this is not the committed money. See, the commitment that I gave is for 10 years, but I'm repaying it before 10 years, maybe at the end of year 3. So I'm paying this. So this is not part of my commitment charges. So if the question is about commitment charges, processing fee, part of commitment charges, part of borrowing cost. You get that? So commitment, this is not committed. It is not part of commitment charges. So processing fee is part of borrowing cost and prepayment charges are not part of borrowing cost. And the next important thing that we need to consider in the process of computation of effective rate is with regard to debentures and with respect to bonds, if there is any discount on issue or premium on redemption. Yes, if any of these debentures or bond, which are basically our financial liability, if they've been received, you would say issued at discount. Example, if I take a debenture of rupees 10, it has to be issued at 10. Now I might tell my debenture holder that you pay me only 9 rupees and I'll give it debenture of 10 rupees. So that is, I'm basically issuing it at 10 rupees. So issuing it at 9 rupees, whereas the money that I'm collecting is 9 rupees and the nominal value is 10. So I'm collecting 9, giving them the benefit of 10. At the time of redemption, I will pay them 10. So I'm collecting 9, paying them 10. So that 1 rupee what I'm not receiving but still repaying is part of my borrowing cost. You get that? So this usually comes because there is a concept of deep discount bonds. You get that? And there's another concept called as zero coupon bonds, wherein the interest rate will be 0. How will someone subscribe for a debenture or a bond which gives 0 interest? That is happening because those debentures will be paid at or will be redeemed at a high amount of premium. Now, if I issue a debentures of rupees 10 and I'll promise you that after 10 years I'll redeem it at 1000 rupees or 100 rupees, then you will still be okay to buying it, irrespective of the fact that I'll not give interest. Why? The interest is accumulated and it is paid as premium on redemption. So, what this interest might be called in different names. It might not be called interest in the face, it might be called as discount on issue, or it might be called as premium redemption. So irrespective of the fact whether it is called as discount on issue or it is called as premium on redemption, it is to be considered in the computation of effective rate because it is part of our interest all by itself. You get that? So discount on issue and premium on redemption both are part of our effective rate computation. Now you might be wondering, how is these two things affecting our effective rate contribution, or to say computation? I'll show it to you by way of an example in the next slide. Come on, let's first see the interest and commitment charges. Assume that I've taken a loan of 1 lakh rupees. How much is the loan that I'm taking? 1 lakh rupees. And with regard to this loan, let us assume a processing fee of 5,000, interest at 10%, and loan term 4 years. Yeah, if that is the case and I need to repay the loan over the period of 4 years. So let us assume there is year, okay, I'll write it in a different color. We have year 0, 1, 2, 3, 4. Yeah, so we have cash. I'll not write cash inflow, cash outflow. Okay, yeah, I can write that, isn't it? That's a simple term, not very difficult. Cash coming in, cash going out. Now, when I borrow the loan, I get cash of rupees 1 lakh. Whereas I would have to pay 5,000 rupees as processing fee. You get that? So my net cash flow becomes how much? It becomes 95. Net cash flow becomes 95,000 in. All the outflows I'll write it as negative, minus. Done. Next, at the end of year 1, I need to repay principal of 25,000 and interest at 10%, that is 10,000. So basically I need to be repaying 35,000 rupees. This is my outflow. And at the end of year 2 again, I will repay 25,000 and I need to pay 10% interest. This time the interest of 10% is not computed on 1 lakh. Out of 1 lakh, I have repaid principal of 25. So what is outstanding is 75,000. On that 75,000 I pay 10% interest. that comes to 7,500. So 25,000 plus 7,500, I might be paying 32,500. So similarly, year 3 also I'll pay 25,000, but this time I'll pay interest also with it. Again, this interest is not on 1 lakh. On 1 lakh, 25 and 25, 2 times I paid principal. So 25 and 25, 50,000 is gone. On the balance 50, I'll pay 10%, that comes to 5,000. This again principal. So 25, okay, 30,000 is the repayment. And again, year 3 I'll pay the balance 25, and on that balance 2,000, 25,000 I pay 2,500 as my interest. So that technically comes down to 27,500. Yeah, you can write it in a little slower manner. You can compute it, opening balance, closing balance of principal, interest. Yeah, you'll get the same thing. So this is principal, interest, principal, interest, principal, interest, principal, interest. So what we need to be cautious here is, this is the net cash flow. This is the net cash flow, and considering this net cash flow of inflow being 95 and outflow being this 35, 32,500, 30 and 27,500, I need to compute IRR rate at which NPV for these cash flows will be 0. So that will become my effective rate. That will become my effective rate, and that effective rate will be considered. Usually what we do is, whenever we want to capitalize borrowing cost, we will find out that borrowing cost, we know, right, interest P into T into R. So people usually pounce on this 10%, which is wrong. This 10% is interest rate, but it is not effective rate. This 10% is the interest rate on 1 lakh. If we receive entire 1 lakh and without, what is a processing fee of 5,000, you get that. Now it will be greater than 10%. I'll write here, effective rate will be definitely greater than 10%, somewhere around like 10.50, 10.60%. I didn't compute it here. If you apply the concept of IRR and then compute, what you get is effective rate. This effective rate is to be put on the loan borrowed to compute the borrowing cost to be capitalized. Now the question is, will I compute the entire period? Will I compute the borrowing cost for the entire period? No. Borrowing cost till the time asset is ready for sale or intended use. Okay, at effective rate will be capitalized. What do you mean by capitalized? Meaning it will be added to the cost of the asset. I hope you understood this part, what I'm talking about, the interest and commitment charges. Now I'll give an example on debentures and bonds. Now assume an example where I have borrowed 1,000 debentures. Okay, I have issued 1,000 debentures of rupees 10 each. You get that? And nominal value is 10, and I'm issuing them at discount of rupees 1, and the premium, okay, I'll write discount on issue. Discount on issue is rupees 1, premium on redemption is rupees 2. You get that? And let us assume this is 10% debentures, or 10, too many tens there. Can I take it as 12%? Yeah, 12% debentures. Now this 12% is not the actual effective rate. We need to compute the effective rate. How do we compute the effective rate? I'll again do the same thing. Here, assume that the redemption is happening at the end of year 4 for our simplicity. Let year 1, I can write 0, 0. Okay, year 0, year 1, year 2, year 3 and year 4. Let us assume that entire debentures are redeemed at the end of year 4, and there is no debentures being redeemed at the end of year 1 or at the end of year 2. If you want, I can write one more, year 5. Yeah, then we'll go for inflow. How much is the inflow here? We usually say 1,000 into 10, 10,000. No, 1,000 into 10 is wrong. 1,000 into 10 minus 1, because issue price is nominal value minus discount. So 10 rupees debenture, I am not receiving 1 rupee because it is discount. I am technically receiving only 9. So 9 into 1,000, 9,000 rupees is my inflow. You get that? And what is the outflow? On this we are paying interest. The interest is paid on nominal value. Interest is not paid on the issue price. So we do 1,000 into 10, 10,000, 10,000 into 12%. 10,000 into 12% comes to 1,200. I'll write here 1,200, 1,200, 1200, 1200. I need to pay 1200 interest in every year. Plus, in the last year, I need to repay. How much will I repay? I will not repay 10,000. I will repay 10,000 plus rupees 2 interest. So basically, I need to repay 12,000 rupees. So if I'm basically find the net cash flow will be 9,000 in, 1,200 outflow, 1,200 outflow, 1,200 outflow, 1,200 outflow, and 13,200 outflow. You get that? So I need to compute I need to apply this concept of IRR here to find the effective interest rate. So that becomes my effective interest rate. For what will I apply IRR? For this net cash flows. Yeah, that effective interest rate what I compute will be considered in computing the borrowing cost to be capitalized. Now, till what period will it be considered? That we'll discuss it in detail. I told you here, this is just mild discussion, not in detail discussion. I'll tell that to you in detail as to how will we basically compute the amount, or from which date till which date will the borrowing cost be capitalized. That we'll discuss it when concept mein. But as of now, did you understand how do we arrive at effective rate? Because the effective rate is not 12%, it is more than 12%. Why? Because effective rate is 12% when I receive 1000 into 10, that is 10,000, and I repay 10,000. But I will not receive 1000 into 10. I'll receive 1 rupee less when I'm receiving, and I'll pay 2 rupees more when I'm repaying. So I'm paying 3 rupees extra. So 3 into 1000, 3000 is a hidden borrowing cost there, and that will be considered in recomputing this 12% into the effective rate of interest, which will be computed in order to help us identify our effective rate and borrowing cost as together. So by this we're done with our interest at effective rate. You get that? So then we would have to discuss the second point. As I told you, we are done with the first one. So what is the next one? Finance cost in the case of leases. So come on, let us go right. Finance cost in the case of leases. So the second thing is finance cost in leases. So come on, let us discuss finance cost in leases. Number 2, finance cost in leases. See, we're going to discuss this in detail in Ind AS 17, which is now Ind AS 116 in detail. But I'll tell you little right now. Whenever we take an asset on lease, we don't get the asset, we get the control on the asset. So with lease, what do we get? We don't get ownership, we get control. And by substance over form, when we have the control, we need to do the accounting. So what do we have? We need to account the asset that we have. In the case of a lease is right to use the asset. Yeah, right to use that specific equipment what we've taken on lease is the asset that we have. And what is the liability that we have? Liability is the lease payments that we need to pay to our lessor. Yeah, so whenever I acquire this specific asset on lease, the journal entry that I'm going to usually write is like this. So it is right of using the asset account debit to lessor account. So this is the entry that I'll pass at the name of acquisition of the asset. Then the next entry that I'm basically going to write is at the end of the year I need to account for the interest, because we would have bought the entire lease liability to the present value. Now what we'll be doing, we'll be taking it to the future value. Yeah, we'll be unwinding the entire lease liability to its original value from the present value. So when you're doing it at the end of every year, we compute the interest. We get that? So when we compute the interest being my expense, I'll write interest, or what do we call finance charges. This will be debited and the credit will be given to my lessor account. Why will I be creating lessor account? Because it's a liability to be paid to lessor. And then the next thing is later it will be paid. I'll write bank account is credit. I'll write to bank. And my debit will be lessor account. That is a liability being repaid. So whenever I am doing this specific finance charges or interest, whatever is debited here, it is in the nature of borrowing cost. It is in the nature of borrowing cost, provided that asset which is taken on lease is qualifying asset. and I told you when that asset is part of a bigger asset, then it will become a qualifying asset with respect to lease and all. Yeah, so that will become borrowing cost, and this should be capitalized. Should be capitalized when such asset taken on lease is a qualifying asset. Now, till any period will I qualify? Till any period will I be capitalizing it? Will I be capitalizing it throughout the lease period? No. When to start, when to end will be detailedly discussed little later when I start answering the question when. But in order to tell you now, from the time the asset becomes ready to use, you will stop capitalizing it anymore. You get that? From the time the asset becomes ready to use or ready for sale, you will stop capitalizing. So till the time the asset becomes ready to use or ready to be sold, till then any borrowing cost that is incurred by the way of interest or financing charges in the process of borrowing in the form of lease, then it will be capitalized. So this is the point of discussion with regard to our, what do we say, yeah, interest costs in finance lease. So I'll write this point to you here. Yeah, finance charges on qualifying asset till it is ready to sell or intended use is capitalized. It is to be capitalized till that date. However, we'll have a detailed discussion with regard to leases in the I think by the number when we are going, it will be the last standard, and we'll discuss it as a last video as a part of our Ind AS series. So then when we understand, we'll get much more clear understanding with regard to how exactly to go about the accounting for leases. So this is with regard to leases, and we are done with this part also successfully. So if we can go to the first part of the standard that we've discussed, I can put a tick mark next to finance cost also. So then we have the next part that's pending, that is exchange differences. So if I start discussing exchange differences now, this will become a really long video. So let us end our current day's discussion with regard to Ind AS 23 here, and in the next video when we start, we'll discuss exchange difference, and we'll also discuss when exactly to start computing borrowing cost, when exactly to stop computing borrowing cost, yeah, which period is included, which period is not included. That will be the last part of our discussion with regard to borrowing cost. So see you all in the third part after this, wherein we'll discuss exchange differences and the starting and the ending period for the purpose of computation of borrowing cost. Till then, stay in the game.